In this morning's U.S. Bank Economic 360, after one of the most highly anticipated initial public offerings in years, shares of the Chinese internet company Alibaba are now trading on the New York Stock Exchange. So 1 week in, is the debut living up to the hype? And what should we look for moving forward? Well, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins Business Courier publisher Jamie Smith in the studio. Mike and Jamie.
Thanks, Peg. Thanks for being here again today, Mike.
Good morning.
So I know we talked about Alibaba some months ago, but just as a refresher for us, what exactly do they do?
Sure. So you can kind of think of it as a one-stop shop, if you will, for the Chinese internet consumer. So it is at base an e-commerce website, and to sort of put it in U.S. terms, it's got a lot of the similarities to eBay, a lot of similarities to Amazon, but then also mix in a lot of other things, some PayPal, some Google, some Match.com. So it's very multi-dimensional and not at all hard to see how it became the most popular website in China.
Quite diversified, huh?
Yeah.
All right, well, I know there was a lot of hype before the IPO. Has it lived up to the hype?
Yeah, in a nutshell, it was huge. The company raised $22 billion, which is now the largest IPO in U.S. history. It beat the previous record of $20 billion by Visa back in 2008. And the hype certainly helped the shares after trading began. They went off at $68 per share and pretty quickly ran up to close to $100 before trending down a little bit and closing in the low 90s. So a very nice first day gain. But as with many ultra-hyped IPOs, the last week or so has been somewhat anticlimactic. So we've seen the shares trend down a little bit further from there.
Well, also we're seeing that there's the stocks may not be exactly what you think it is. There may be some risk that you didn't really think about. Talk a little bit about those risks.
Exactly, and this got I think lost in a lot of the hype. And the twist is that shares of Alibaba's stock may not be actual shares of Alibaba. And what I mean by that is, in the U.S., for instance, if you buy shares of stock in a company, you are literally buying an ownership interest. That's why we call it equity.
Right.
So if you have shares of Procter & Gamble, you own a piece of Procter & Gamble. Unfortunately for Alibaba, China has very strict rules about foreigners owning Chinese companies, so they couldn't sell equity directly to U.S. investors. So to sort of work around the regulations, they had to set up a shell company in the Cayman Islands, and then it's that shell company that U.S. investors are actually buying an interest in. Now, there is a contractual obligation in which the Chinese owners of Alibaba will share a portion of their profits with the shell company, which in turn will share those profits with U.S. investors. So it's a little bit convoluted, but to make it even more complicated is that Chinese courts have said that even this sophisticated workaround may not be entirely legal. And some U.S. observers have said that they're a little bit skeptical as well. So that's a pretty big gray area. And clearly we won't know how it plays out until further down the road. But I think the bottom line is, if you're going to invest in Alibaba, which certainly seems to have great growth potential, A, be aware of what it is that you're actually buying, and B, recognize that there are some unique risks involved that you don't find with the typical stock investment.
Wow. Well, I'm sure you'll keep us abreast of what all these when changes happen or what the results are.
Exactly.
Well, great. Thanks for being here today.
Thank you, Jim.